Right now, I mean, millions of everyday retail traders are staring at these red and green candlestick charts on their monitors, right?
Right.
And they are absolutely convinced they are reading the market.
Oh, completely convinced. Yeah,
But
yeah.
what they don't realize is they're looking at the financial equivalent of a fossil. They are reacting to history. The line went up, the line went down, but by the time it actually renders on the screen, the real move has already happened.
Exactly. It's already over.
Right. So the day's deep dive is really about what happens when you wipe away that history, throw away the fossils entirely, and look at the exact mechanics of the future.
It is a massive paradigm shift. You basically stop reacting to the shadows of a market, and you start looking at the actual light source, if that makes sense.
It does. And our mission today is to really decode the cutting-edge mechanics of modern market microstructure and institutional-grade trading. Specifically, we're looking at a platform called 3D NEXUS META V7.
Yes, V7. And we have a massive stack of source material for this deep dive.
We really do. We've got their official complete user guide, the dual MT5 Bridge manual, the prediction oracle module guide, and the actual transcripts from the official masterclass training plan by the platform's creator, NikoZ.
And, this stack of sources is just incredible because it really pulls back the curtain. It shows exactly how new visualization tools, when you combine them with artificial intelligence, are completely changing how a retail trader can read the market.
Absolutely. So whether you are an active day trader desperately looking for an edge, maybe someone prepping for a fintech meeting, or you are just insanely curious about how AI is, quietly eating Wall Street right now, this deep dive is perfectly tailored to give you a clear, totally jargon-free understanding of modern trading architecture.
Yeah, we're going to break it all down.
So let's jump right into the deep end here. The sources begin by completely dismantling the biggest flaw in how most people view the stock or crypto markets, which they refer to as the retail blind spot.
Right, the blind spot. To really understand this, the sources outline what they call the three-layer framework. Because most retail traders, and honestly the mainstream brokers that serve them, they operate entirely on layer one.
Layer one being price, right? Just the traditional candlestick chart.
Exactly. But price is merely the consequence. It's the result of a battle that has already been fought.
Okay, so a trailing indicator.
Right. If you want to know why the price moved, you have to look deeper into the architecture. So layer two is volume. This is the cause, the actual active demand in the market.
Like who is actually buying and selling in that exact moment?
Precisely. It tells you exactly who is aggressively buying and selling, at what specific price, and in what quantity. But even looking at volume isn't enough on its own. You need layer three, which is liquidity.
Liquidity. The buzzword of the century.
Yeah, it is. But in this context, it is the environment, the supply. It represents all the pending resting limit orders that are just waiting in the order book.
Okay, let's unpack this. Because trying to trade by only looking at price, it's sort of like trying to drive a car by staring exclusively at the speedometer.
Oh, that's a great way to put it.
Like, you know exactly how fast you're going in that specific moment, but you have absolutely no idea if there's a massive brick wall of liquidity parked right in front of you on the road.
That captures the danger perfectly. And it really brings us to the fundamental equation of the market that the masterclass transcripts hammer home over and over.
Right, let's hear it.
So it's volume is greater than liquidity equals price moves. It is pure mechanics.
Volume greater than liquidity equals price moves.
Right. Imagine there are 10 market buy orders coming in, so that's your active demand, but there are only 5 sell limit orders resting at that exact price level.
Okay, so more buyers than sellers at that specific tick.
Exactly. The market must automatically tick upward to find the next available sellers to fill the rest of those orders. Demand exceeds supply, so the price physically has to rise to find more supply. That is the entire game.
Let me pause you there. So if I'm understanding this right, if the order book is completely empty, like if liquidity is just super thin, a tiny, tiny amount of volume can send the price skyrocketing.
Yes.
So it's not necessarily about how many people are buying, it's about the total lack of resistance.
You've hit the nail on the head. That is exactly how flash crashes or massive spikes happen. It creates this illusion of extreme demand when in reality it's just a complete vacuum of liquidity.
Wow. Which, I mean, begs the obvious question. If this equation is the literal physics of the market, why on earth are retail traders stuck staring at candlesticks? Why isn't everyone looking at volume and liquidity?
Well, the sources point to a very deliberate incentive structure. Retail brokers actually have a massive financial incentive to keep you focused only on price.
Of course they do.
Right, because they make their money on commissions and the spread, meaning they want you trading frequently, just pinging back and forth all day.
Getting chopped up.
Exactly. Providing you with deep data, the actual mechanics of Layer 2 and Layer 3 is wildly expensive for them to host and stream.
Oh, that makes sense.
And furthermore, if you could see how often the market is perfectly balanced or how often it's actively setting a trap, you would trade far less. So by keeping you in the dark, you're forced to react to the consequence, which just keeps you clicking buy and sell.
That is wild. But here is the immediate problem I see. Once you realize price isn't enough, trying to look at raw volume and liquidity data is, it's like trying to read the matrix.
It really is.
It is just endlessly scrolling spreadsheets of rapidly changing numbers.
Mm-hmm.
How does a normal human brain process all of that without suffering a total meltdown from information overload?
It generally can't, which is the specific problem 3D NEXUS META V7 was built to solve. It takes that raw, overwhelming Level 2 order book data and actually renders it as a scrolling 3D terrain.
Okay.
And the crazy part is it does this directly in a web browser. There's no complex installation, just an HTML file interpreting massive data streams.
The visual description of this in the user guide is absolutely wild.
Yeah.
Like, it renders the bids so the buyers as these giant green mountains on one side of a canyon.
Yep. A literal visual canyon.
And the asks the sellers form red mountains on the other side. And the actual executed trades fall from the sky as colored spheres. They call them persistent trade bubbles.
Right, and the physical size of those spheres correlates directly to the size of the trade.
So wait, the bigger the trade, the bigger the bubble?
Exactly. So you can literally sit there and watch a giant green sphere drop out of the sky, land on a red mountain, and watch that mountain physically shrink.
Wow. That's incredible.
It is. It gives you a spatial representation of that volume versus liquidity equation. You don't have to read numbers anymore. You just watch the terrain change in real time.
The user guide also highlights different visual modes tailored for specific scenarios, which I found fascinating. There was one called Canyon V1.5, which you use to read the depth of a market right before a potential breakout.
Right. So you can visually see which side of the canyon has thicker walls holding the price in.
Yeah. And then there's a mode called X-Ray V4, which honestly sounds like a cheat code.
X-Ray V4 is critical for survival because it detects institutional layering and unmasks what the industry calls spoofs.
Spoofs, like fake orders.
Exactly. A spoof is a massive fake wall of orders that a large institutional player places in the book to manipulate the market. They basically want to scare everyone into moving a certain direction with the full intention of pulling those orders before they ever actually get filled.
So they flash a huge sell wall to cause a panic, everyone sells, the price drops, and then they cancel their sell wall and buy the dip.
That's spoofing. But X-ray mode tracks the age of the liquidity. If a massive mountain of orders just suddenly appears out of nowhere, X-ray highlights it in a specific color, warning you that this is likely manipulation, not true supply.
That is super powerful. I do have to push back here on one thing, though.
Yeah.
The documentation mentions the platform has various visual templates, and the default one is called NEXUS Cyber.
Ah, yes, the cyber theme.
Yeah, it features neon purple and green colors, glitch effects, scan lines. Does making this look like a gamified cyberpunk video game actually help a trader? Or is it just distracting them from serious financial data? It sounds like an arcade machine, honestly.
It does sound like an arcade machine, but what's fascinating here is the underlying cognitive science.
Oh, really?
Yeah, the human brain processes 3D spatial data and color mapping exponentially faster than it can ever process a scrolling column of numbers. The gamified aesthetic, those jarring neon colors and stark contrasts, it isn't just for show.
It has a purpose.
A very specific one. It is engineered to instantly highlight anomalies. When a massive spoof wall gets pulled by an institution, you don't have to do mental math on a spreadsheet to notice a number dropped. You just see a giant neon mountain instantly vanish.
So it's about reaction speed.
Exactly. It deliberately reduces the cognitive load so the trader can react in milliseconds.
Okay, so the arcade aesthetic is actually a highly functional tool, but that brings up a glaring issue to me. Seeing a 3D neon mountain of sellers vanish in a millisecond is entirely useless if human reflexes are too slow to click the mouse.
True. Very true.
Like, you can see the future, but you can't physically react to it fast enough.
Yeah.
That forces a handoff to the machines, bringing us to the brains of this whole operation, the swarm AI and the prediction oracle.
The technical architecture outlined here is just staggering. For instance, the prediction oracle V2 runs on just 35 kilobytes of memory.
Wait, 35 kilobytes for an AI?
Yes.
To put that in perspective for you listening, 35 kilobytes is smaller than a standard text email. How is that even possible?
It is incredibly compact, and the reason it has to be that tiny is crucial. It means there is zero garbage collection pressure.
Garbage collection? Okay, translate that for me.
So in software programming, garbage collection is when a computer program has to momentarily pause to clean out its memory, essentially taking out the digital trash, right? If an AI is bloated with code, it pauses frequently to do this. In high-frequency trading, a microsecond pause to clear memory is the exact difference between capturing a massive profit and eating a catastrophic loss.
Wow, okay, so it has to be lean.
Extremely lean. Because it's so small, the oracle never stutters. And importantly, it uses 7 real-time level 2 predictors to forecast probabilities rather than relying on past indicators.
I want to drill down into those predictors because the jargon gets a little heavy in the guide here. It mentions order flow imbalance and microprice. How do those actually work?
Think of order flow imbalance as the active tug-of-war rope. It measures the pure aggression between market buyers and market sellers in real time. If the imbalance swings wildly to the buyers, the rope is being pulled hard.
Makes sense. And microprice.
Microprice is even more clever. Instead of just looking at the midpoint between the bid and the ask, which is what your candlestick chart does, microprice weighs the actual volume resting at those levels. So if there are 1,000 buyers and only 10 sellers at a certain price point, the microprice shifts heavily toward the buyers before the actual mid-price ever even moves.
Oh, wow. It's like predicting the snap of the rubber band before it breaks.
Exactly. And the Oracle forecasts this across 6 different time horizons simultaneously, ranging from just 5 seconds out to 2 minutes out.
That's intense. But working alongside the Oracle is something called the NEXUS swarm. The manual says this swarm is made of 5 autonomous AI agents powered by Cerebras Llama 3.3 and Quant models.
Yes, the swarm.
Now hold on. Llama and Quant are large language models. They're built to generate text to chat. Why on earth are they using a language model to read numerical market data?
I know, it seems completely counterintuitive, but think about how order flow actually works. It is sequential data.
Sequential, like a story.
Exactly. A massive buy order, followed immediately by a wave of pulled sell orders, followed by aggressive market buying. That sequence is essentially a sentence. The market is speaking a language.
Oh, that's brilliant.
Right. Just like a language model predicts the next logical word in a sentence, these models are trained to predict the next logical market event based on the sequence of the order book.
That makes terrifying sense. The market literally has a grammar. And you had these 5 AI agents with, by the way, wild names like the Iceberg Assassin and the Spoof Warden.
Great names.
Amazing names.
Yeah.
And they're reading this grammar, analyzing the market, and feeding their findings up to something called a consensus overlord.
Yes, the consensus overlord takes all those complex, sometimes conflicting signals from the different agents and synthesizes them into a single directional verdict.
So it's the boss.
It is. It even utilizes a vocal oracle feature, which uses text-to-speech to literally speak the updates out loud to you while you trade.
Wait, like it talks to you?
Yeah. So if you are focused intensely on the 3D visual surface, the AI just tells you in your ear, 82% bull, bid liquidity surging.
So you never break visual contact with the terrain.
Exactly. It's a literal co-pilot sitting there with you.
That is insane.
Right.
But I want to circle back to the defense mechanisms, because AI isn't just looking for opportunities to attack. The manual says it's actively trying to keep you out of traps.
Absolutely. Survival is key. This is where the Quant engine comes in, specifically utilizing a metric called VPIN.
VPIN. What does that stand for?
It stands for Volume Synchronized Probability of Informed Trading.
Okay, that is a mouthful.
It is, but what it does is measure the likelihood that insiders or highly informed institutional traders are dominating the current flow. If that VPI metric exceeds 80%, the market regime is officially flagged by the system as TOXIC.
I love that. I absolutely love that they officially use the word toxic in the documentation.
I mean, it's the most accurate word for it.
Yeah.
When the market is toxic, your standard technical edge completely vanishes.
Because the game is rigged at that moment.
Right. You are swimming with sharks who have information you don't. When the platform detects this, it automatically suppresses subtle signals. It basically tells the trader, we are only going to trade the most aggressive, undeniable momentum bursts right now, or we are just sitting on our hands.
That is so smart. But here's where it gets really interesting to me. What happens when the AI agents violently disagree with each other? Say the Oracle's tug-of-war metrics say the price is going up, but the Swarm AI language model reads the sequence and says, no, this is a trap.
The platform handles that with a feature called the conflict bar.
Conflict bar.
Yeah. If the Oracle and the Swarm diverge, a massive flashing alert warns the user to stay flat. Do not trade. It is a hard-coded mechanism to prevent human overconfidence.
Oh, that's really good.
If two highly advanced, completely independent AI systems cannot agree on where the market is going, you have absolutely no business risking your own money on a gut feeling.
Okay, so we've mapped out the 3D vision. We have the AI language models predicting the future. We have the toxic market filters keeping us out of shark-infested waters. But once the AI actually spots a genuine edge, the challenge becomes capturing it, right?
Yes, execution is
A
everything.
microsecond delay, and all this math completely falls apart. So how does the platform actually move the money?
It relies on a piece of infrastructure called the Dual MT5 Bridge. MT5 stands for MetaTrader 5, which is a pretty standard execution terminal. But Nexus doesn't just connect to your broker, it connects to two completely separate brokers simultaneously.
Now, why complicate it with two brokers? That seems like a headache.
Because in this high-speed game, different brokers specialize in different things. You might use one broker, say Ava Futures, for example, purely as your data station.
Okay.
They provide exceptional, ultra-heavy, level 2 market depth data straight from the Chicago Mercantile Exchange.
But I'm guessing their actual execution isn't great.
Exactly. Their trading fees or spreads might be terrible for rapid scalping. So you hook up a second broker like IC Markets purely as your execution station to place the actual trades.
Because they offer the tightest spreads and the lowest latency.
You've got it.
It's like having two cell phones. One phone is on a network with absolute perfect reception, so you can hear the breaking news a split second early. And then the second phone has a direct, dedicated hardline to your bookie, allowing you to place the bet before anyone else even registers the news.
That is exactly the architecture. You completely decouple the heavy data source from the lightning-fast execution venue. And once that bridge is built, the AutoTrader V7 engine sits right on top of it.
Speaking of the AutoTrader, the documentation mentions a two-step process that really caught my eye.
Oh, the anti-slippage mechanism.
Yeah. Instead of just firing off a market order with a preset take profit and stop loss already attached to it, it sends the order, waits for the exact confirmation of where the order was actually filled, and only then calculates and applies the stops. Why the delay? Doesn't that slow things down?
It's designed specifically to combat slippage. In a violent, fast-moving market, the price you click on your screen is almost never the exact price you get filled at.
Right, you click at 10, you get filled at 12.
Exactly. So if your stop loss was calculated based on the theoretical price you thought you were getting, your risk profile is suddenly entirely wrong. You could be risking double what you intended.
That makes total sense. So the two-step process ensures your risk-reward ratio is bolted to reality, not theory.
Exactly. It recalculates instantly based on the actual fill.
The masterclass transcripts also go very deep into how this AutoTrader effectively enforces psychological discipline through code. There's a feature called the Smart Martingale. Now, a standard martingale where you double your bet size after every loss to try and recover is famous for being the fastest way to go bankrupt in a casino.
It is a notorious account killer, yes.
So how is this one smart?
Well, the Smart Martingale in Nexus does step up the trade size after losses to recover a drawdown, but it strictly requires the user to input a hard cap before it ever runs. You cannot let the algorithm run infinitely until your account hits 0.
Okay, so it has a built-in safety net.
Right. It completely prevents a recovery strategy from mutating into what NikoZ calls a suicide strategy.
And it also mandates daily profit and loss limits.
Yeah.
Right? I read that if you hit your profit target for the day, the app literally shuts down your trading capabilities.
It turns off? Yeah.
The same applies if you hit your maximum loss limit. It just shuts down. It completely removes the possibility of emotional tilt, where you get cocky and give back all your winnings, or you start revenge trading to win back a massive loss.
And that, honestly, is the secret sauce. The AutoTrader isn't some magical money-printing robot. It is simply your own discipline, hard-coded into software.
Taking the human element out of it.
Exactly. It
Yeah.
executes your rules emotionlessly while you just focus on reading the terrain.
Which brings us to the climax of all this material, the playbook. How do these tools actually perform when the rubber meets the road?
Right. Let's look at a real example.
The masterclass walks through a specific real-world use case from March 26, 2026, trading the E-mini S&P 500 futures.
Yes, the ES. So in this example, the market was stuck in a tight compression zone at a price of 6586.0.
Let's quickly paint the picture for the listener here. A compression zone is basically psychological torture for a normal trader.
Oh, the worst.
The price is just vibrating in a tiny range. Human traders get chopped to pieces here because they keep guessing which way it will break. They jump in, they jump out, taking small losses until their account just bleeds out completely.
Exactly. The human trader is frustrated and emotional, but the AI is just patiently watching the math. And in this specific compression zone, 3 distinct signals fired in sequence on the 3D NEXUS platform.
Walk us through them.
First, the absorption sage triggered. The platform visually highlighted a massive wall of buy orders that held completely steady against a desperate wave of selling. The sellers were throwing everything they had at the wall, and it just wasn't denting it.
The Green Mountain stood firm.
It didn't budge. Then, the second signal hit, the delta spike. Suddenly, a massive flood of active buy volume entered the market. The buyers stopped waiting around and became the active aggressors.
And finally, the third signal.
The Stalp engine confirmed that the ask side the sellers resting above was thinning out. The red mountains were physically vanishing. There was absolutely no supply left to resist the demand.
So the system took a long entry at 6588.8, and according to the guide, it resulted in a surgically precise 2-point win.
Beautifully executed.
I mean, it wasn't guessing based on a moving average. It read a structural story, right? Support held, demand violently surged, and supply vanished. And the visual tools let the trader literally watch that story unfold in 3D.
It's incredible. And the sources also detail the platform's most profitable strategy overall, which they call the Oracle Confluence Momentum Setup.
Okay, what does that entail?
It requires a staggering amount of alignment. 4 out of the 6 Oracle time horizons must agree with over 75% confidence simultaneously.
Wow, that's strict.
Very. Plus, the market regime has to be flagged as elevated volatility, and importantly, the Hawk's branching ratio has to be over 0.6.
Okay, another big term there, Hawk's branching ratio. Explain that one for us.
Sure, think of it like an avalanche. A Hawk's process measures how much one event causes another event to happen.
Like a chain reaction.
Exactly. In trading, if I sell heavily, I might push the price down into your stop-loss order. Your stop-loss triggers a market sell, which pushes the price down further into someone else's stop-loss. One falling rock dislodges 3 more.
Got it. So a ratio over 0.6 means what?
It means the market is highly reactive.
Yeah.
Individual trades are currently triggering cascading chains of other trades.
So you are basically waiting for the avalanche to start, confirming it's a real avalanche, and then just riding it.
Exactly. It's a highly, highly restrictive strategy. You essentially sit on your hands waiting for the stars to perfectly align. The physics of the market have to completely favor you before you risk a single dollar.
So what does this all really mean for the trader? There is a quote from the creator in the masterclass transcripts that honestly sums up this entire deep dive for me.
Let's hear it.
He says, "A trade not taken doesn't hurt. A bad trade does."
Yeah. If we connect this to the bigger picture, that quote is basically the foundational philosophy of modern institutional trading.
Truly.
The best traders in the world aren't the ones who catch every single move, or even the ones with the absolute highest win rate. The absolute best traders are simply the ones who never lose their entire month's profit in a single emotionally unhinged session.
They engineer survival.
Yes. They survive because they rely on structural advantages to see the truth, and they use code to enforce their discipline when their human emotions want to panic.
To wrap this all up, we have journeyed from the absolute blind spot of reacting to 2D candlestick price charts, stepping right into the fully visualized 3D terrain of volume and liquidity. We've explored how swarm AI language models read the grammar of that battlefield in real time, and finally, how dual bridge architecture and auto-trading algorithms execute the plan without a single drop of human emotion.
It's a lot to take in.
It is. But you now have a comprehensive understanding of how institutional-grade order flow trading actually functions right behind the scenes.
It really is a terrifyingly beautiful system. I mean, we are watching everyday retail traders arm themselves with analytical weapons that, honestly, just a decade ago, were exclusively locked away on the servers of elite quantitative hedge funds.
Which brings up a final provocative thought for you to mull over. If platforms like NEXUS Meta can give an everyday retail trader a 3D AI-driven multi-horizon probabilistic cockpit that genuinely rivals Wall Street's
Oh,
algorithms.
I see where you're going with this.
What happens to the market when every single retail trader has one of these?
That is the million-dollar question.
If everyone can suddenly see through the fog, does the edge disappear entirely because the market finally reaches perfect efficiency? Or does it just evolve into an even faster, more ruthless AI arms race where the fog just gets thicker and even harder to read?
It's something we'll all be watching very closely.
We will leave you with that. Thanks for taking the deep dive with us today.